Listen. Practice. Speak. Practice makes you perfect.
We need to allocate resources efficiently. We need to allocate resources efficiently. Let's set a realistic budget for the next quarter. Let's set a realistic budget for the next quarter. Our priority is to reduce unnecessary expenses. Our priority is to reduce unnecessary expenses. The budget should reflect our business goals. The budget should reflect our business goals. Finance business English phrases will repeat 2 times. First, listen the financial business English phrases and then practice with me. This expense needs to be justified. This expense needs to be justified. Financial reporting. We need to close the books by the end of the month. We need to close the books by the end of the month. The report highlights our key financial metrics. The report highlights our key financial metrics. Let's review the income statement for any discrepancies. Let's review the income statement for any discrepancies. The balance sheet shows our assets and liabilities. The balance sheet shows our assets and liabilities. We need to provide accurate financial disclosures. We need to provide accurate financial disclosures. Cash flow management. Cash flow management is critical for business stability. Cash flow management is critical for business stability. Let's focus on improving our cash inflows. Let's focus on improving our cash inflows. We need to monitor cash outflows closely. We need to monitor cash outflows closely. Are we maintaining adequate cash reserves? Are we maintaining adequate cash reserves? Ensuring positive cash flow is a priority. Ensuring positive cash flow is a priority. Budgeting and planning, continued. We must evaluate our spending against the budget. We must evaluate our spending against the budget. Our budget is flexible to accommodate changes. Our budget is flexible to accommodate changes. Let's optimize costs to increase profitability. Let's optimize costs to increase profitability. We should prioritize high-return investments. We should prioritize high-return investments. Project costs must be monitored closely. Project costs must be monitored closely. Financial reporting, continued. Our financial statements need to comply with regulations. Our financial statements need to comply with regulations. Revenue forecasts should be updated regularly. Revenue forecasts should be updated regularly. The audit ensures the accuracy of our accounts. The audit ensures the accuracy of our accounts. All financial records should be up to date. All financial records should be up to date. The profit and loss statement summarizes earnings. The profit and loss statement summarizes earnings. Cash flow management, continued. Forecasting cash flows helps in planning expenses. Forecasting cash flows helps in planning expenses. Delayed payments impact our cash flow negatively. Delayed payments impact our cash flow negatively. We need strategies to speed up cash inflows. We need strategies to speed up cash inflows. Managing cash flow reduces financial stress. Managing cash flow reduces financial stress. Maintaining liquidity is essential for operations. Maintaining liquidity is essential for operations. Investment strategies. Investing in growth opportunities drives profits. Investing in growth opportunities drives profits. We should diversify our investment portfolio. We should diversify our investment portfolio. Assessing risk is crucial before investing. Assessing risk is crucial before investing. Our return on investment, ROI, is a key metric. Our return on investment, ROI, is a key metric. Market trends can affect investment outcomes. Market trends can affect investment outcomes. Risk management. Identifying risks helps us prepare for potential losses. Identifying risks helps us prepare for potential losses. We need to assess financial risks regularly. We need to assess financial risks regularly. Risk mitigation strategies are crucial for stability. Risk mitigation strategies are crucial for stability. Insurance protects against unforeseen financial risks. Insurance protects against unforeseen financial risks. Diversification helps minimize investment risks. Diversification helps minimize investment risks. Accounting basics. Revenue recognition is essential in accounting. Revenue recognition is essential in accounting. We must reconcile all accounts monthly. We must reconcile all accounts monthly. Assets and liabilities must be accurately recorded. Assets and liabilities must be accurately recorded. Depreciation impacts our financial statements. Depreciation impacts our financial statements. Accurate bookkeeping is key to financial health. Accurate bookkeeping is key to financial health. Taxation. We must comply with all tax regulations. We must comply with all tax regulations. Tax deductions can reduce our taxable income. Tax deductions can reduce our taxable income. Let's file our taxes before the deadline. Let's file our taxes before the deadline. Understanding tax credits is beneficial. Understanding tax credits is beneficial. Our tax strategy aligns with our financial goals. Our tax strategy aligns with our financial goals. Financial analysis. Analyzing financial ratios gives us insights. Analyzing financial ratios gives us insights. Trend analysis helps in making informed decisions. Trend analysis helps in making informed decisions. Our return on assets is a measure of efficiency. Our return on assets is a measure of efficiency. Profit margins indicate our cost management success. Profit margins indicate our cost management success. Variance analysis highlights budget deviations. Variance analysis highlights budget deviations. Expense management. Reducing overhead costs can improve our margins. Reducing overhead costs can improve our margins. We need to track travel expenses closely. We need to track travel expenses closely. Cost control is essential for staying on budget. Cost control is essential for staying on budget. Each department should monitor its spending. Each department should monitor its spending. High expenses can impact profitability. High expenses can impact profitability. Revenue generation. Let's identify ways to boost revenue. Let's identify ways to boost revenue. Our primary focus is revenue growth. Our primary focus is revenue growth. New products could increase our revenue. New products could increase our revenue. We need to diversify our revenue streams. We need to diversify our revenue streams. Increasing sales will improve our revenue. Increasing sales will improve our revenue. Cost analysis. Cost-benefit analysis aids decision-making. Cost-benefit analysis aids decision-making. Identifying fixed costs helps in budgeting. Identifying fixed costs helps in budgeting. We need to reduce variable costs. We need to reduce variable costs. Operating costs impact our bottom line. Operating costs impact our bottom line. Cost structure analysis shows profitability. Cost structure analysis shows profitability. Asset management. Asset management is key to financial health. Asset management is key to financial health. We need to evaluate our asset portfolio. We need to evaluate our asset portfolio. Fixed assets need regular maintenance. Fixed assets need regular maintenance. Leasing assets could reduce costs. Leasing assets could reduce costs. Assets should be aligned with business goals. Assets should be aligned with business goals. Debt management. Managing debt efficiently is crucial for cash flow. Managing debt efficiently is crucial for cash flow. Reducing outstanding debt improves our financial health. Reducing outstanding debt improves our financial health. Our debt-to-equity ratio affects investor confidence. Our debt-to-equity ratio affects investor confidence. We need to restructure our debt to lower interest costs. We need to restructure our debt to lower interest costs. Debt consolidation can simplify our financial obligations. Debt consolidation can simplify our financial obligations. Profitability analysis. Our gross profit margin is an indicator of efficiency. Our gross profit margin is an indicator of efficiency. Improving net profit margin boosts our bottom line. Improving net profit margin boosts our bottom line. Return on equity, ROE, measures shareholder value. Return on equity, ROE, measures shareholder value. We need to increase our operating profit margin. We need to increase our operating profit margin. Analyzing profitability helps with financial planning. Analyzing profitability helps with financial planning. Credit management. We need to manage credit risk effectively. We need to manage credit risk effectively. Monitoring credit limits can prevent bad debts. Monitoring credit limits can prevent bad debts. Credit terms must be clearly defined. Credit terms must be clearly defined. Improving credit rating can reduce interest rates. Improving credit rating can reduce interest rates. Extending credit to reliable customers boosts sales. Extending credit to reliable customers boosts sales. Capital management. Managing capital efficiently is key for growth. Managing capital efficiently is key for growth. We should reinvest profits to increase capital. Finance business English phrases will repeat 2 times. First, listen the financial business English phrases and then practice with me. We should reinvest profits to increase capital. Capital expenditures must be strategically planned. Capital expenditures must be strategically planned. A higher capital base allows for expansion. A higher capital base allows for expansion. Our capital structure impacts financial flexibility. Our capital structure impacts financial flexibility. Cost allocation. We need to allocate costs accurately across departments. We need to allocate costs accurately across departments. Proper cost allocation improves financial reporting. Proper cost allocation improves financial reporting. Cost allocation helps in assessing departmental performance. Cost allocation helps in assessing departmental performance. We need a transparent cost allocation process. We need a transparent cost allocation process. Accurate cost allocation aids in budgeting. Accurate cost allocation aids in budgeting. Expense reduction. Reducing operational expenses increases profitability. Reducing operational expenses increases profitability. We need to identify areas for cost cutting. We need to identify areas for cost cutting. Reducing utility expenses can save costs. Reducing utility expenses can save costs. Eliminating wasteful spending is a priority. Eliminating wasteful spending is a priority. Reducing fixed costs can increase flexibility. Reducing fixed costs can increase flexibility. Revenue recognition. Revenue recognition must follow accounting standards. Revenue recognition must follow accounting standards. We need to recognize revenue when it's earned. We need to recognize revenue when it's earned. Revenue recognition affects our financial statements. Revenue recognition affects our financial statements. Clear revenue recognition policies prevent issues. Clear revenue recognition policies prevent issues. Timely revenue recognition is critical for accuracy. Timely revenue recognition is critical for accuracy. Dividend management. We should decide on an appropriate dividend payout. We should decide on an appropriate dividend payout. Dividends impact shareholder satisfaction. Dividends impact shareholder satisfaction. Retaining earnings can reduce dividend payouts. Retaining earnings can reduce dividend payouts. Our dividend policy affects investor interest. Our dividend policy affects investor interest. Sustainable dividends are a sign of financial health. Sustainable dividends are a sign of financial health. Financial auditing. Regular financial audits ensure transparency. Regular financial audits ensure transparency. We need to prepare thoroughly for the audit. We need to prepare thoroughly for the audit. Audits help verify the accuracy of our records. Audits help verify the accuracy of our records. External audits enhance credibility. External audits enhance credibility. Compliance with audit standards is mandatory. Compliance with audit standards is mandatory. Cost of goods sold, COGS. Tracking COGS helps manage production costs. Tracking COGS helps manage production costs. Reducing COGS can improve profit margins. Reducing COGS can improve profit margins. Accurate COGS reporting affects gross profit. Accurate COGS reporting affects gross profit. COGS calculation includes all production costs. COGS calculation includes all production costs. We need to monitor COGS for price adjustments. We need to monitor COGS for price adjustments. Budget revisions. We may need to revise the budget based on changes. We may need to revise the budget based on changes. Budget revisions should be approved by management. Budget revisions should be approved by management. Frequent budget revisions can indicate poor planning. Frequent budget revisions can indicate poor planning. Let's review budget allocations for accuracy. Let's review budget allocations for accuracy. Budget adjustments should align with goals. Budget adjustments should align with goals. Financial strategy. Our financial strategy guides investment decisions. Our financial strategy guides investment decisions. A strong financial strategy enhances stability. A strong financial strategy enhances stability. Our strategy should align with market conditions. Our strategy should align with market conditions. Long-term financial strategy ensures growth. Long-term financial strategy ensures growth. Adapting strategy helps in changing environments. Adapting strategy helps in changing environments. Working capital management. Working capital management is crucial for liquidity. Working capital management is crucial for liquidity. We need to balance current assets and liabilities. We need to balance current assets and liabilities. Improving working capital boosts operational efficiency. Improving working capital boosts operational efficiency. Reducing working capital improves cash flow. Reducing working capital improves cash flow. Working capital management impacts financial health. Working capital management impacts financial health. Financial ratios. Financial ratios give insight into performance. Financial ratios give insight into performance. The current ratio measures liquidity. The current ratio measures liquidity. Profitability ratios assess business success. Profitability ratios assess business success. Debt ratios indicate financial leverage. Debt ratios indicate financial leverage. Efficiency ratios evaluate asset utilization. Efficiency ratios evaluate asset utilization. Forecasting. Forecasting helps in strategic planning. Forecasting helps in strategic planning. We need to update financial forecasts regularly. We need to update financial forecasts regularly. Accurate forecasting reduces uncertainty. Accurate forecasting reduces uncertainty. Sales forecasting impacts revenue projections. Sales forecasting impacts revenue projections. Let's use data to improve forecasting accuracy. Let's use data to improve forecasting accuracy. Investment analysis. Investment analysis is essential for portfolio growth. Investment analysis is essential for portfolio growth. Evaluating risk and return helps in decision-making. Evaluating risk and return helps in decision-making. We should diversify investments to mitigate risk. We should diversify investments to mitigate risk. Long-term investment analysis ensures sustainable growth. Long-term investment analysis ensures sustainable growth. Investment analysis includes both financial and market factors. Investment analysis includes both financial and market factors. Asset management. Asset management maximizes the value of resources. Asset management maximizes the value of resources. We need to regularly assess asset performance. We need to regularly assess asset performance. Efficient asset management reduces operational costs. Efficient asset management reduces operational costs. Fixed asset tracking is essential for accuracy. Fixed asset tracking is essential for accuracy. Effective asset management helps with resource allocation. Effective asset management helps with resource allocation. Financial planning. Financial planning aligns our resources with goals. Financial planning aligns our resources with goals. Comprehensive financial planning supports long-term growth. Comprehensive financial planning supports long-term growth. Regular updates are essential to effective financial planning. Regular updates are essential to effective financial planning. Financial planning helps manage future cash flows. Financial planning helps manage future cash flows. Strategic planning improves decision-making. Strategic planning improves decision-making. Liquidity management. Liquidity management ensures we meet short-term obligations. Liquidity management ensures we meet short-term obligations. We must maintain a healthy liquidity position. We must maintain a healthy liquidity position. Liquidity ratios measure our ability to pay debts. Liquidity ratios measure our ability to pay debts. Improving liquidity can enhance financial flexibility. Improving liquidity can enhance financial flexibility. Efficient liquidity management boosts investor confidence. Efficient liquidity management boosts investor confidence. Capital budgeting. Capital budgeting decisions impact future profits. Capital budgeting decisions impact future profits. Evaluating projects is key in capital budgeting. Evaluating projects is key in capital budgeting. Capital budgeting helps allocate funds to profitable projects. Capital budgeting helps allocate funds to profitable projects. We need to analyze project cash flows carefully. We need to analyze project cash flows carefully. Sound capital budgeting leads to sustainable growth. Sound capital budgeting leads to sustainable growth. Cost control. Cost control is essential for maintaining profitability. Cost control is essential for maintaining profitability. We need strict monitoring to ensure cost control. We need strict monitoring to ensure cost control. Cost control involves reducing unnecessary expenses. Cost control involves reducing unnecessary expenses. Setting budget limits is key for effective cost control. Setting budget limits is key for effective cost control. Improved cost control can increase profit margins. Improved cost control can increase profit margins. Financial ratios analysis. Ratio analysis provides insights into financial health. Ratio analysis provides insights into financial health. Profitability ratios show our earning potential. Profitability ratios show our earning potential. Liquidity ratios help assess short-term solvency. Liquidity ratios help assess short-term solvency. Debt ratios measure our financial leverage. Debt ratios measure our financial leverage. Efficiency ratios show how well we use assets. Efficiency ratios show how well we use assets. Risk assessment. Risk assessment is critical in investment planning. Risk assessment is critical in investment planning. Understanding risk helps make informed decisions. Understanding risk helps make informed decisions. Risk assessment involves evaluating potential losses. Risk assessment involves evaluating potential losses. Managing risk protects against financial instability. Managing risk protects against financial instability. We should conduct regular risk assessments. We should conduct regular risk assessments. Equity financing. Equity financing raises funds through investors. Equity financing raises funds through investors. Issuing equity can dilute ownership. Issuing equity can dilute ownership. Equity financing doesn't require debt repayment. Equity financing doesn't require debt repayment. Equity investors seek a return on their investment. Equity investors seek a return on their investment. Equity financing is ideal for growth stage companies. Equity financing is ideal for growth stage companies. Mergers and acquisitions. Mergers and acquisitions create growth opportunities. Mergers and acquisitions create growth opportunities. M&A can lead to cost efficiencies and synergies. M&A can lead to cost efficiencies and synergies. Due diligence is essential in mergers and acquisitions. Due diligence is essential in mergers and acquisitions. M&A can increase market share and competitiveness. M&A can increase market share and competitiveness. We need a clear strategy for successful M&A. We need a clear strategy for successful M&A. Venture capital supports high-growth startups. Venture capital supports high-growth startups. VC investors seek equity stakes in businesses. VC investors seek equity stakes in businesses. Venture capital funding comes in stages. Venture capital funding comes in stages. VC investment can accelerate business growth. VC investment can accelerate business growth. Venture capitalists expect high returns. Venture capitalists expect high returns. Cost-benefit analysis. Cost-benefit analysis helps in decision-making. Cost-benefit analysis helps in decision-making. We weigh costs against potential benefits. We weigh costs against potential benefits. Effective cost-benefit analysis prevents overspending. Effective cost-benefit analysis prevents overspending. Cost-benefit analysis is essential for project evaluation. Cost-benefit analysis is essential for project evaluation. Regular analysis can improve resource allocation. Regular analysis can improve resource allocation. Profit margin analysis. Profit margin shows business profitability. Profit margin shows business profitability. High profit margins indicate financial health. High profit margins indicate financial health. Profit margins depend on cost control. Profit margins depend on cost control. Improving profit margins increases shareholder value. Improving profit margins increases shareholder value. Profit margin analysis helps identify cost savings. Profit margin analysis helps identify cost savings. Credit risk. Credit risk assessment reduces default probability. Credit risk assessment reduces default probability. Effective credit risk management is essential for lenders. Effective credit risk management is essential for lenders. Credit scores help evaluate risk. Credit scores help evaluate risk. We use credit history for assessing loan eligibility. We use credit history for assessing loan eligibility. Minimizing credit risk protects against losses. Minimizing credit risk protects against losses. Revenue forecasting. Revenue forecasting predicts future income. Revenue forecasting predicts future income. Income. Accurate forecasting supports strategic planning. Accurate forecasting supports strategic planning. Revenue forecasts influence budget decisions. Revenue forecasts influence budget decisions. Forecasting involves analyzing market trends. Forecasting involves analyzing market trends. Reliable forecasts help manage cash flow. Reliable forecasts help manage cash flow. Fixed costs and variable costs. Fixed costs remain constant regardless of output. Fixed costs remain constant regardless of output. Variable costs fluctuate with production levels. Variable costs fluctuate with production levels. Cost control requires managing both fixed and variable costs. Cost control requires managing both fixed and variable costs. Reducing fixed costs improves profit margins. Reducing fixed costs improves profit margins. Variable costs increase with higher production. Variable costs increase with higher production. Financial modeling. Financial modeling helps predict business outcomes. Financial modeling helps predict business outcomes. Models use data to estimate future performance. Models use data to estimate future performance. Financial models support investment decisions. Financial models support investment decisions. Modeling helps assess the impact of business strategies. Modeling helps assess the impact of business strategies. Effective models improve resource allocation. Effective models improve resource allocation. Cash flow forecasting. Cash flow forecasting ensures liquidity. Cash flow forecasting ensures liquidity. We project cash flows to plan for expenses. We project cash flows to plan for expenses. Accurate cash flow forecasting prevents shortages. Accurate cash flow forecasting prevents shortages. Forecasting improves cash management practices. Forecasting improves cash management practices. Projected cash flows support budgeting decisions. Projected cash flows support budgeting decisions. Financial statements analysis. Financial statement analysis shows company performance. Financial statement analysis shows company performance. We analyze statements for financial insights. We analyze statements for financial insights. Analysis includes income statements and balance sheets. Analysis includes income statements and balance sheets. Financial analysis helps with decision-making. Financial analysis helps with decision-making. Regular analysis improves financial transparency. Regular analysis improves financial transparency. Capital allocation. Capital allocation maximizes investment returns. Capital allocation maximizes investment returns. We allocate capital based on project potential. We allocate capital based on project potential. Efficient capital allocation enhances profitability. Efficient capital allocation enhances profitability. Resource allocation should align with business goals. Resource allocation should align with business goals. Capital allocation decisions impact future growth. Capital allocation decisions impact future growth. Finance business English phrases will repeat 2 times. First, listen the financial business English phrases and then practice with me. Financial projections guide future planning. Financial projections guide future planning. Accurate projections support strategic decisions. Accurate projections support strategic decisions. Financial projections help set realistic goals. Financial projections help set realistic goals. Projections provide insights into potential risks. Projections provide insights into potential risks. Regularly updated projections improve accuracy. Regularly updated projections improve accuracy. Expense management. Expense management reduces unnecessary costs. Expense management reduces unnecessary costs. Tracking expenses ensures budget adherence. Tracking expenses ensures budget adherence. Efficient expense management boosts profitability. Efficient expense management boosts profitability. The company needs to improve its cash flow. The company needs to improve its cash flow. We should analyze the balance sheet for insights. We should analyze the balance sheet for insights. The capital gains tax is due next month. The capital gains tax is due next month. Diversification can reduce investment risk. Diversification can reduce investment risk. Our debt-to-equity ratio is too high. Our debt-to-equity ratio is too high. We need a solid investment portfolio strategy. We need a solid investment portfolio strategy. The market capitalization of the company has increased. The market capitalization of the company has increased. Net income has improved this quarter. Net income has improved this quarter. We must control our operating expenses carefully. We must control our operating expenses carefully. Return on investment, ROI, is a key performance indicator. Return on investment, ROI, is a key performance indicator. Shareholder equity reflects the company's net worth. Shareholder equity reflects the company's net worth. Treasury stock can impact earnings per share. Treasury stock can impact earnings per share. Understanding valuation methods is essential for investors. Understanding valuation methods is essential for investors. Working capital is crucial for daily operations. Working capital is crucial for daily operations. The yield curve indicates future interest rates trends. The yield curve indicates future interest rates trends. We are currently in a bear market phase. We are currently in a bear market phase. Investors are optimistic about the bull market ahead. Investors are optimistic about the bull market ahead. A strong credit rating can lower borrowing costs. A strong credit rating can lower borrowing costs. Economic indicators help predict market trends. Economic indicators help predict market trends. Financial leverage can amplify returns and risks. Financial leverage can amplify returns and risks. Hedge funds often employ complex strategies to maximize returns. Hedge funds often employ complex strategies to maximize returns. An initial public offering, IPO, can raise significant capital for growth. An initial public offering, IPO, can raise significant capital for growth. Market volatility can create both opportunities and risks for investors. Market volatility can create both opportunities and risks for investors. The P/E ratio helps assess if a stock is overvalued or undervalued. The P/E ratio helps assess if a stock is overvalued or undervalued. Effective risk management is vital for financial stability. Effective risk management is vital for financial stability. The Securities Exchange facilitates trading of financial assets. The Securities Exchange facilitates trading of financial assets. Tax liability must be calculated accurately to avoid penalties. Tax liability must be calculated accurately to avoid penalties. The underwriting process determines the risk of issuing new securities. The underwriting process determines the risk of issuing new securities. Value investing focuses on buying undervalued stocks for long-term gains. Value investing focuses on buying undervalued stocks for long-term gains. Asset management involves overseeing investments to meet client goals. Asset management involves overseeing investments to meet client goals. Maintaining adequate cash reserves is essential for liquidity purposes. Maintaining adequate cash reserves is essential for liquidity purposes. The dividend yield provides insight into a stock's profitability relative to its price. The dividend yield provides insight into a stock's profitability relative to its price. Monitoring the expense ratio helps evaluate fund performance efficiently. Monitoring the expense ratio helps evaluate fund performance efficiently. A financial analyst plays a crucial role in investment decision-making processes. A financial analyst plays a crucial role in investment decision-making processes. Gross profit margin indicates how efficiently a company produces goods or services. Gross profit margin indicates how efficiently a company produces goods or services. Interest rate risk affects bond prices inversely when rates rise or fall sharply. Interest rate risk affects bond prices inversely when rates rise or fall sharply. We monitor expenses to optimize cash flow. We monitor expenses to optimize cash flow. Expense management requires regular review. Expense management requires regular review. Debt management. Debt management ensures financial stability. Debt management ensures financial stability. We aim to reduce high-interest debt. We aim to reduce high-interest debt. Debt management includes repayment planning. Debt management includes repayment planning. Effective debt management improves credit rating. Effective debt management improves credit rating. Managing debt helps maintain cash flow. Managing debt helps maintain cash flow. Return on investment, ROI. ROI measures investment profitability. ROI measures investment profitability. High ROI indicates effective resource use. High ROI indicates effective resource use. We calculate ROI to assess project success. We calculate ROI to assess project success. Monitoring ROI helps prioritize investments. Monitoring ROI helps prioritize investments. Improving ROI boosts overall profitability. Improving ROI boosts overall profitability. Capital structure. Capital structure includes debt and equity. Capital structure includes debt and equity. A balanced capital structure reduces risk. A balanced capital structure reduces risk. We assess capital structure for financial health. We assess capital structure for financial health. Capital structure impacts cost of capital. Capital structure impacts cost of capital. Optimal structure maximizes shareholder value. Optimal structure maximizes shareholder value. Accounts receivable. Accounts receivable are funds owed to us. Accounts receivable are funds owed to us. Managing receivables improves cash flow. Managing receivables improves cash flow. We monitor receivables to ensure timely payments. We monitor receivables to ensure timely payments. High receivables constrain cash reserves. High receivables constrain cash reserves. Reducing overdue accounts improves liquidity. Reducing overdue accounts improves liquidity. Financial health. Financial health indicates business stability. Financial health indicates business stability. Positive cash flow shows financial health. Positive cash flow shows financial health. We measure health through profitability ratios. We measure health through profitability ratios. Healthy finances attract investors. Healthy finances attract investors. Financial health requires regular assessment. Financial health requires regular assessment. Working capital management. Working capital management ensures liquidity. Working capital management ensures liquidity. We manage working capital to meet short-term needs. We manage working capital to meet short-term needs. Efficient management reduces financial strain. Efficient management reduces financial strain. Adequate working capital supports operations. Adequate working capital supports operations. Working capital affects daily business activities. Working capital affects daily business activities. Cash flow statement. The cash flow statement tracks inflows and outflows. The cash flow statement tracks inflows and outflows. It shows our ability to generate cash. It shows our ability to generate cash. The cash flow statement helps with budgeting. The cash flow statement helps with budgeting. We analyze cash flows to assess liquidity. We analyze cash flows to assess liquidity. Accurate cash flow reports support planning. Accurate cash flow reports support planning. Balance sheet analysis. The balance sheet shows assets, liabilities, and equity. The balance sheet shows assets, liabilities, and equity. It provides a snapshot of financial health. It provides a snapshot of financial health. Assets minus liabilities equals equity. Assets minus liabilities equals equity. Analyzing the balance sheet informs decisions. Analyzing the balance sheet informs decisions. The balance sheet impacts investment appeal. The balance sheet impacts investment appeal. Financial ratios. Financial ratios measure business performance. Financial ratios measure business performance. Ratios help compare profitability and efficiency. Ratios help compare profitability and efficiency. Liquidity ratios show short-term financial health. Liquidity ratios show short-term financial health. Debt ratios assess the level of leverage. Debt ratios assess the level of leverage. Profitability ratios indicate business success. Profitability ratios indicate business success. Earnings before interest and taxes, EBIT. EBIT measures operating profitability. EBIT measures operating profitability. It excludes interest and tax expenses. It excludes interest and tax expenses. EBIT helps compare operational efficiency. EBIT helps compare operational efficiency. We analyze EBIT to understand core earnings. We analyze EBIT to understand core earnings. Higher EBIT indicates strong business performance. Higher EBIT indicates strong business performance. Capital gains. Capital gains are profits from asset sales. Capital gains are profits from asset sales. They occur when an asset's value increases. They occur when an asset's value increases. Capital gains are taxable income. Capital gains are taxable income. Investors aim to realize capital gains. Investors aim to realize capital gains. Gains depend on market and economic conditions. Gains depend on market and economic conditions. Asset management. Asset management optimizes resource use. Asset management optimizes resource use. It maximizes return on assets. It maximizes return on assets. Effective asset management reduces risk. Effective asset management reduces risk. We manage assets to improve profitability. We manage assets to improve profitability. Asset tracking supports strategic planning. Asset tracking supports strategic planning. Dividends. Dividends are payments to shareholders. Dividends are payments to shareholders. They distribute company profits to investors. They distribute company profits to investors. Dividend policy affects investor decisions. Dividend policy affects investor decisions. Stable dividends indicate financial stability. Stable dividends indicate financial stability. Companies may reinvest profits instead of dividends. Companies may reinvest profits instead of dividends. Break-even analysis. Break-even analysis determines profitability. Break-even analysis determines profitability. It calculates the sales needed to cover costs. It calculates the sales needed to cover costs. Break-even analysis aids pricing decisions. Break-even analysis aids pricing decisions. It shows when a business becomes profitable. It shows when a business becomes profitable. Accurate analysis improves financial planning. Accurate analysis improves financial planning. Overhead costs. Overhead costs are indirect expenses. Overhead costs are indirect expenses. They include rent, utilities, and administration. They include rent, utilities, and administration. Reducing overhead improves profit margins. Reducing overhead improves profit margins. We track overhead costs to control spending. We track overhead costs to control spending. Overhead affects overall profitability. Overhead affects overall profitability. Gross profit margin. Gross profit margin shows profitability before expenses. Gross profit margin shows profitability before expenses. It's calculated by subtracting COGS from revenue. It's calculated by subtracting COGS from revenue. Higher margins indicate better cost control. Higher margins indicate better cost control. Gross margin helps assess production efficiency. Gross margin helps assess production efficiency. We analyze margins to improve profitability. We analyze margins to improve profitability. Investment portfolio. An investment portfolio is a collection of assets. An investment portfolio is a collection of assets. Diverse portfolios reduce financial risk. Diverse portfolios reduce financial risk. Portfolios include stocks, bonds, and real estate. Portfolios include stocks, bonds, and real estate. Finance business English phrases will repeat 2 times. First, listen the financial business English phrases and then practice with me. Balanced portfolios aim for steady returns. Balanced portfolios aim for steady returns. Portfolio management is key for growth. Portfolio management is key for growth. Retained earnings. Retained earnings are reinvested profits. Retained earnings are reinvested profits. They fund growth and expansion. They fund growth and expansion. Retained earnings appear on the balance sheet. Retained earnings appear on the balance sheet. They reflect long-term business success. They reflect long-term business success. Higher retained earnings indicate profitability. Higher retained earnings indicate profitability. Investment portfolio. An investment portfolio includes a mix of assets. An investment portfolio includes a mix of assets. Diversifying a portfolio reduces risk. Diversifying a portfolio reduces risk. We monitor the portfolio to maximize returns. We monitor the portfolio to maximize returns. Portfolios are tailored to investor goals. Portfolios are tailored to investor goals. Balanced portfolios manage risk and reward. Balanced portfolios manage risk and reward. Interest expense. Interest expense is the cost of borrowing. Interest expense is the cost of borrowing. High interest expenses reduce profitability. High interest expenses reduce profitability. Interest expense is a regular financial obligation. Interest expense is a regular financial obligation. We aim to reduce interest expenses where possible. We aim to reduce interest expenses where possible. Managing interest expense improves cash flow. Managing interest expense improves cash flow. Capital budgeting. Capital budgeting is for long-term investments. Capital budgeting is for long-term investments. We analyze capital budgets for profitability. We analyze capital budgets for profitability. Capital budgeting helps in resource allocation. Capital budgeting helps in resource allocation. Projects are selected based on return potential. Projects are selected based on return potential. Capital budgeting decisions impact future growth. Capital budgeting decisions impact future growth. Tax planning. Tax planning helps minimize tax liabilities. Tax planning helps minimize tax liabilities. Effective planning can improve cash flow. Effective planning can improve cash flow. We consider tax implications in budgeting. We consider tax implications in budgeting. Tax planning requires up-to-date knowledge. Tax planning requires up-to-date knowledge. Minimizing tax expenses maximizes profits. Minimizing tax expenses maximizes profits. Economic indicators. Economic indicators show the health of the economy. Economic indicators show the health of the economy. We monitor indicators to guide financial strategy. We monitor indicators to guide financial strategy. Indicators include GDP, inflation, and employment. Indicators include GDP, inflation, and employment. Economic indicators influence investment decisions. Economic indicators influence investment decisions. Staying informed on indicators aids planning. Staying informed on indicators aids planning. Hedging. Hedging protects against financial risk. Hedging protects against financial risk. We use hedging strategies in volatile markets. We use hedging strategies in volatile markets. Hedging helps stabilize cash flows. Hedging helps stabilize cash flows. Common hedging instruments include options. Common hedging instruments include options. Effective hedging mitigates unexpected losses. Effective hedging mitigates unexpected losses. Dividend policy. A dividend policy determines payouts to shareholders. A dividend policy determines payouts to shareholders. Stable dividends attract investors. Stable dividends attract investors. Dividends are based on profit and growth plans. Dividends are based on profit and growth plans. We adjust the policy according to company performance. We adjust the policy according to company performance. Dividends affect shareholder satisfaction. Dividends affect shareholder satisfaction. Cost control. Cost control improves profitability. Cost control improves profitability. We monitor costs to avoid unnecessary spending. We monitor costs to avoid unnecessary spending. Reducing costs increases competitive advantage. Reducing costs increases competitive advantage. Cost control requires efficient budgeting. Cost control requires efficient budgeting. Controlling costs is crucial for financial health. Controlling costs is crucial for financial health. Mergers and acquisitions, M&A. Mergers and acquisitions support growth. Mergers and acquisitions support growth. We analyze M&A for strategic fit. We analyze M&A for strategic fit. Acquisitions expand market share. Acquisitions expand market share. M&A decisions involve complex financial analysis. M&A decisions involve complex financial analysis. Effective M&A integrates company cultures. Effective M&A integrates company cultures. Asset valuation. Asset valuation determines market worth. Asset valuation determines market worth. We use valuation to inform investment decisions. We use valuation to inform investment decisions. Accurate asset valuation is key for reporting. Accurate asset valuation is key for reporting. Valuation methods include cost and market approaches. Valuation methods include cost and market approaches. Asset valuation impacts balance sheet accuracy. Asset valuation impacts balance sheet accuracy. Compliance and regulation. Compliance ensures adherence to laws and policies. Compliance ensures adherence to laws and policies. Financial regulation protects investors. Financial regulation protects investors. We update policies to meet regulatory standards. We update policies to meet regulatory standards. Non-compliance can result in penalties. Non-compliance can result in penalties. Regular audits support compliance efforts. Regular audits support compliance efforts. Break-even analysis. Break-even analysis shows profit threshold. Break-even analysis shows profit threshold. We calculate break-even to assess pricing. We calculate break-even to assess pricing. Break-even helps in financial planning. Break-even helps in financial planning. Reaching break-even is a key business goal. Reaching break-even is a key business goal. Break-even points vary by cost structure. Break-even points vary by cost structure.